Hello and Assalamu alaikum everyone. I am Kashif Kamran and a very warm welcome to the Advanced Audit and Assurance webinar to success for June 2022 exams. Today is the second day of this webinar and the first part of the day 2, and we have a very important agenda today for the day 2 part 1. Let's take a look at the agenda. Yesterday, on the first day, part 1 and part 2, we were focusing on a study planner for the last 18 days before exam and some very important exam tips and techniques, including the time management techniques within the first day. Now, today is the second day, a very important day, and the day 2 will get connected with day 3 because on the day 2 today, we are looking at the September-December 21 paper and the question number 1 with the examiner report and how to take control of the practice platform. Tomorrow on the day 3, we have the same agenda. We have the September-December 21 paper, but that would be question number 2 and question number 3 alongside the examiner report and again taking command of the practice platform. So we have the entire paper September-December 21 stretch over the next 6 hours, day 2 and day 3. Let's resume. Let's start with the first part of the day 2 today. So welcome to the day 2 for the webinar to success for Advanced Audit and Assurance for June 22 exams. And I am your tutor, Kashif Kamran. Let's resume the proceedings. Now, before I take you to the practice platform and we start drilling the answer of the question on the practice platform, we are looking at the first question of the September-December 21 exams. And we will be drilling it as much as possible within the constraint of the 3 hours. I will be analyzing the examiner report and I will be giving you an emphasis on the marking scheme as well. So we have 3 things within 3 hours. So you need to understand there is a shortage of time, there is a constraint of time within which maximum possible things will be fitted in. So you get the maximum benefit out of the session today. Everything is not possible. Everything is not humanly possible, but I try to do my best in the 3 hours so that you get the maximum benefit within the 3 hours of the day 2. So a drill inside out of the question number 1, and then the analysis of the examiner report and the marking scheme. The question number 1, right, of the September-December 21 exams. Now, when you look at the question number 1 of the September-December 21 exam, which is the most latest paper available and uploaded, the first question contains a briefing note requirement, and you have to present the answer in the form of a briefing note. And you have 4 professional marks allocated with the briefing note, and I will be sharing the examiner feedback on that as well. So you have briefing note in the September-December 21 paper, question number 1, as it is always with every question number 1, and that briefing note has 4 requirements, A, B, C, D. The first requirement was planning matters specific to the initial audit engagement. So what sort of planning matters will you be considering in the first year audit? That was number 1. Number 2 was to look at significant audit risk. So the second requirement was the significant audit risk, which is to be delivered for maximum number of marks. The marks allocation was 24, I guess. Then you had audit procedures on a certain area, and then you had ethical issues and action. So these are 4 requirements making up the 46 technical marks. And then you had 4 marks attached to the briefing note, making it a total of 50. Now, we decided upon the time management for the first question yesterday, ideally how much time you should be spending on the first question in terms of reading and planning time and the writing time. So approximately we had like 23 to 24 minutes of a reading and planning time for the first question, and approximately 75 minutes of a writing time. So that's what you need to follow when you are practicing at home, because it's a live session and where I am drilling and discussing and giving you the tips and techniques. Automatically the time stretch will increase on. So this is the first question. This is a realistic view of the first question. Now let's start understanding how would you approach it on the practice platform, and a lot more to be discussed today. Let me share with you the practice platform on the screen. I hope you can all see the practice platform on the screen. Please confirm that. Okay, if you can all see the practice platform, that's great enough. And this is the main screen, right? This is the first question. Now, because you must have practiced a lot of question number 1 prior to your actual exam sitting, and you must have practiced a lot of question number 1 on the practice platform. So when you enter the actual exam for June 22, you are familiar with many things where you are not wasting your time. Now, for example, when you open the first question in the actual exam, or the one right in front of you, you exactly know which is the first thing to open. On the left-hand side, the very first thing you will open is the partner email, because you know the partner email contains the requirements of the first question. You will not search for requirements in the requirement area, but you will search for the requirements in the partner email, because the ABCD is in the partner email. So the very first thing you should open on your screen immediately when you're looking at the first question is you click on the partner email and it opens up. And that's the most important thing. And simultaneously, you open up the briefing note from the response option. So 2 windows, right? 2 windows simultaneously. 1 window of a briefing note, which is the word processor, and 1 window of the partner email, which is the first exhibit which contains the requirement. And you are pretty sure of this because you must have practiced so many question number 1 that this is the 2 most important things on your screen currently. Now, within 5 minutes, when you are attempting the question number 1 and you don't know the case study, you don't know what's happening in the case study, how difficult the case study is, you just need to spend 5 minutes in structuring the briefing note quickly. See, how would you do it? The briefing note, you can see the to, from, subject, date on the right-hand side of the screen, which is the partner email. So I simply copy the to, from, date, subject, Control C, and I bring it to my briefing note. In the briefing note, I put the heading briefing note. And under that, I copy paste the to, from, date, subject. Right now, something will change, because in the partner email, when you're responding to the partner email, the to will become the from and the from will become the to, right? So I will change that. The to will become the from. So the to will become the audit partner, and it's from the audit manager. So that is the correction you have to do, because you were looking at the email on the right-hand side of the screen. So the to becomes the from and the from becomes the to, because you're replying back to the email. The subject remains the same, and there is no need of a date in a briefing note. So you simply remove the date. Now, after that, you will quickly write introduction without even knowing what the examiner is asking for. After the introduction, you can see on the right-hand side of the screen, A, B, C, D. You don't know what's happening in the A, B, C, D, right? But you simply say introduction A, introduction B, introduction C, and finally D. And in the last, you put a conclusion. See, within just 2 minutes, you can set up a briefing note. I hope you're all fine with that. Are you all fine with it? So within just 2 minutes, you put up the briefing note, right? Right. So you put up the briefing note, you put up the to, the from, the subject by copy pasting it from the email of the partner, and then the introduction, A, B, C, D, and the conclusion. So how much time will that take? 2 minutes. Now, you don't know what is to be done in A, what is to be done in B, what is to be done in C, and what is to be done in D. But let's start reading it. Now, the first thing, the partner says, hello, I have provided you with some information which you have to use with planning the audit of the Grubber company for the financial year ending 30th of September 2025. As you know, Grubber is a new client of the firm, and the client due diligence and acceptance procedures were all successfully completed. So have we successfully completed the client acceptance procedure? Yes. Have we accepted the client? Yes. So Grubber is a new client and we have accepted this new client. So we have already done the client screening of Grubber and we have accepted Grubber as a new client. So very important information here is that Grubber is a new client. So we already have the first very crucial information here. Grubber is a new client. So that's important. So I go to my highlighter and I highlight it. Grubber is a new client. Right, so Grubber is a new client, number one. Okay, back to my briefing note. I require you to prepare a briefing note. I've already structured a briefing note. Number A, discuss the matters specific to planning the initial audit engagement, which should be considered in developing the audit strategy. So what I need to do in the number A, matters specific to the planning of the initial audit engagement. Control C, and I put it here. Control V, A. Number 2, using the exhibit 1, 2, 3, 4, evaluate the significant audit risk. So I need to evaluate the significant audit risk in the requirement number B. But which exhibits I have to use for significant audit risk? Only the exhibit 1, 2, 3, and 4. Should I use the exhibit 5 for finding the audit risk? No. So just to be on the safe side, I'm writing in the briefing note, exhibit 1, 2, 3, 4. I will delete it later, but at least to remember that I have to find the risk from the 4 exhibits, not the 5 exhibits. Okay, number C, principal audit procedures in respect of the Nakatomi building. So there is a Nakatomi building and I need to perform procedures on the Nakatomi building. So I just copy pasted that on my briefing note. And then the last one, discuss the ethical issues. So I need to discuss the ethical issues and recommend actions in the last requirement. Control C, and I bring it down here. See, my briefing note is structured. I know what 4 things I have to do. I need to discuss the planning matters for the initial audit engagement, number A. I need to evaluate significant audit risk, number B. I need to design the principal audit procedures on a Nakatomi building. And I need to discuss the ethical issues only with actions in number D. So this is my briefing note in front of the screen. Now, something before I close my partner email. Examiner is saying that I need to evaluate the risk from only the 4 exhibits and the marks available to me is 24. I will delete the marks later. At least I know how much to write. For the matter specific to planning, I just have 6 marks. So at least I know how much to write. So I'll just put the marks and I will later delete the marks once I wrote the answer. For the principal audit procedures, I have another 8 marks. And then finally, for ethical issues, I have 8 marks. So that's how you're going down with it. Now, examiner is telling us something very important in the requirement A. And a lot of times students ignore it. Can you see the note number under the requirement A? And students literally ignore the note number. They don't concentrate on the note number. The note number can tell you something very important, which can change the answer. Now, in the note number, the examiner is telling you, as above, you do not need to discuss matters relating to whether it was appropriate to accept Grubber as a client, as acceptance is confirmed. So have we already accepted Grubber as a new client? Yes. So examiner is saying you should not be worried about whether we should have accepted Grubber or we should not have accepted Grubber, because already the examiner is telling you or the partner is telling you that we have accepted Grubber. So you're not worried about it. So the decision has been taken that Grubber is a new client. Now you need to involve in planning the first year audit of Grubber company. And you have 6 marks for that. And now you close the partner email. Now, this is the briefing note in front of your screen. And in the briefing note, you have everything ready. You just need to fill it up. So in the first 5 minutes of your question number 1, you open the 2 windows, right? Which 2 windows? The partner email and the briefing note. And you take information from the partner email and you dump it into the briefing note. So within 5 minutes, the briefing note is ready. Now, once the briefing note is ready, it is very easy to spend time on the briefing note and to fill up the briefing note, right? So that's exactly what I will be doing now. I will just be filling up the briefing note and guiding you about more tips and techniques. Is everyone clear so far, so forth, what I've done? Please respond so we proceed further. Okay, so all of you are clear, right? So that means we can proceed further. Now, step 2. Now we have closed the partner email. We know what exactly is to be done in the partner email. No more need of the partner email, right? Now let's go first. Introduction. Now, whenever you are writing the introduction of a briefing note, the introduction means the purpose of the briefing note. Why are you writing this briefing note? Now we know we are writing this briefing note for A, B, C, D. And the introduction should not be more than 2 sentences long. Introduction should be very summarized. See how I put the introduction. The introduction starts with the purpose of writing. The purpose of writing this briefing note is to explain the matters specific to planning the first year audit, including evaluation of significant audit risk, procedures on the Nakatomi building, and the ethical issues. Full stop. See, I just sum up. The purpose of writing this briefing note is to explain the matters specific to the planning of the first year audit, including evaluation of the significant risk, procedures on the Nakatomi building, and the ethical issues. So this is how the briefing note should be, right? So you need to have a very skimmed looking introduction. Now that's how you write the introduction of a briefing note. Now the second requirement, matters specific to the planning of the initial audit engagement. Examiner is not asking you for a client screening procedures because you've already done the client screening and you've already accepted Grubber as a client. But examiner is asking for matters specific to planning the first year audit because you are developing an audit strategy. You are developing an audit strategy for the first year audit. So what specific matters will you consider when you are planning the first year audit of any company? In our case, it's the Grubber company. Let's see, do we have any help in the exhibits? I'm opening the second exhibit after the partner email, which is business and governance. Let's open that up. Okay. Look at the screen in front, right? It tells us it is the 1st of July. You are a manager in the audit department of McLean & Company, a firm of chartered certified accountant. You are assigned to the audit of Grubber, which has the financial year end of 30th of September. Grubber is a new client. The audit firm has been appointed in January 20X5, and the audit was previously done by Ellis Associate. So the previous auditor was Ellis Associate, right? So Ellis Associate was the previous auditor, and we are the new auditor, right? And it's a new audit client. Grubber is a new audit client. So If Grubber is a new audit client, is it important? Is it important to put it somewhere in my briefing note? Yes. Evaluate the significant audit risk. Grubber is a new audit client. And I believe if Grubber is a new audit client, that should be my audit risk. So I'm getting some information about audit risk, that it's a new audit client and there could be a detection risk. I will later develop the answer. But I got some information which I should copy paste in the relevant heading. So the relevant heading was B. Now, there was a previous auditor, Ellis. Can the previous auditor help me with knowing the critical areas where I should be focusing on planning the first year audit? Can the previous auditor working papers help me knowing what are the risky areas where I should be focusing on in the first year audit? Can the previous auditor help me to know what are weaknesses in the internal control system which were identified in the previous year, so I can focus my test of controls in that area? I believe you know that the previous auditor is important, because the previous auditor can tell you lots of issues, weaknesses, risk pertaining to the last year audit, which can help you plan this year audit. So the previous auditor is a source which can be used when you are planning the first year audit. Further information, Grubber is owned and managed by Grubber family. So it's not a listed company, it's a family-based business, and its principal operation means design and construction of the bespoke machinery. Okay, now we open up the second exhibit, business and governance. Now, the second exhibit tells us the company was established 15 years ago by Martin, an engineer who had patented a new type of machine used in the oil industry. Martin, who is the company's chief executive officer, owns 60% of the shares in company, with the remainder split equally between the brother and sister, Craig and Iris. So it's a family business, right? Martin and having 60% shares, and the remaining shares is split between the brother and sister, Craig and Iris. It's not a listed company, right? The company board of director includes Craig Grubber as a chief executive officer, Iris Grubber as a marketing director, and a non-family member, Kelly, who is a director of operations. And the list goes on. Martin is planning to sell shares and retire from the business, so on and so forth. I think there is no information available for planning the new audit client. We need to write the answer, taking the journal knowledge we have for planning the new audit client. Most of the information here is about audit risk. So we just close it up. We'll come back when we are doing the audit risk. But let's currently look at this. Let me take you to the examiner report first. I hope you can see the examiner report on your screen now. Can you all see the examiner report on your screen for the September-December 21 question? Okay, great. So we are looking at the question number 1, right? Examiner report, section A. Section A, question number 1. So we are looking at the examiner report for section A, question number 1. You go down, and the examiner is telling us about the first question. Let's go to the first requirement, right? Okay, can you all see the first requirement being covered by the examiner in the report? This is the first requirement for 6 marks, right? Discuss the matters specific to the planning of the initial audit engagement. And you're not conducting any client screening procedure because Grubber has already been accepted as a client. You're only looking at what sort of things you will focus on when you are planning the first year audit. Now look at what the examiner is telling you before we reach a conclusion. What is a good answer? The requirement required candidates to consider matters which are relevant to the initial audit of a new client. Disappointingly, many candidates struggle to attempt the question or omitted it entirely. Look at this wording of the examiner. Look at this wording of the examiner. Disappointingly, a 6 marks requirement, many candidates struggle to attempt it. I don't find what is the reason of not attempting it or struggling to attempt it. Isn't a very simple requirement. Discuss the matters specific to the planning of the initial audit engagement? What sort of matters will you consider when you are planning the first year audit? And I'll just be giving you the answer. But examiner is saying many candidates struggle or they didn't attempt it. Then the examiner comes with stronger candidate. I highlighted the stronger candidate in green because every time I recommend my student, when you are reading the examiner report, take a red color and a green color. If something is favorable, put it in green. If something is bad, put it in red. So you will get to know, okay, the red is a bad thing and green is a good thing. Now see what the examiner is telling us. Stronger candidates were able to discuss the planning issues specific to the first time audit, such as interaction with the previous auditor with regards to the working paper. For example, in assessing the appropriateness of the accounting policy used by the client, details of the related party and the transactions, full stop. They were also able to take more journal planning matters and describe them in the context of a new client. For example, additional time for understanding the system and controls because it's a first year audit due to lack of knowledge from the previous audit, as well as the requirement to audit the opening balances. See, the examiner is saying the stronger candidates were able to do this. Let me take it on my Word file for the day 2. And we are looking at September, December 21. Question number 1, part A for 6 marks. And for this requirement, the examiner is telling us when you are looking at the matters specific to the planning of the first year audit, and you had 6 marks for this, this is what the examiner is telling us. No, you have screened the client. You have accepted the client after you have screened the client and you didn't found any instances that the client is bad. Client acceptance procedure is something different, right? And planning matters are something different, Abhishek. When you are accepting a client, you look into whether the client is involved in money laundering, tax evasion. Is the client good? Is the client bad? Are the directors involved in any fraudulent activities? You are more down to the client integrity screening, Abhishek. But when you are doing the planning of the first year audit, you are looking at how much time is required to perform the audit, or what are risky areas where you should focus on when you go to the audit, what are critical areas in the financial statement where you should focus on, how much time you should be spending on the understanding of the controls because it's a first year audit. So there is a big difference between the client screening procedures and the planning matters. I hope you're clear with that, Abhishek. And that's what the examiner is telling us, that disappointingly, many students struggle completing this answer or didn't attempt it at all. I hope you're clear, right? So what is the question asking? Matters specific to the planning of the first year audit. So examiner is saying stronger candidates were able to discuss the planning issues for the first time audit, such as interaction with the previous auditor with regards to the working papers. For example, the appropriateness of the accounting policy and the details of the related party, etc. So when I'm planning the first year audit, do you believe this is a very good point? Interaction with the previous auditor? Is this a very specific matter that when I'm planning the first year audit, I should interact with the previous auditor and ask the previous auditor about the accounting policies, about the appropriateness of the accounting policy? Is there something wrong in the accounting policy? Is there a risk in the accounting policy? Is the management using a wrong accounting policy? So should I interact the previous auditor? Should I review the working papers of the previous auditor when I'm planning the first year audit? Will that be of benefit? Examiner is saying this was a stronger answer. So I should know about the accounting policies when I'm planning the first year audit. And I should know about related parties when I'm planning the first year audit. So these are specific areas which I should be knowing when I'm planning the first year audit. Yes, you have a right to interact with the previous auditor, right? You have the right to interact with the previous auditor. There is an interesting question coming from a student 17 days away from the exam. Why should we ask the previous auditor? The previous auditor has left. As a new auditor, you have a responsibility, and this is part of your professional behavior, that you interact with the previous auditor. We are not writing all that, right? We're not writing that you should take permission of the client. The question is not asking for that. We are assuming we have permission, right? Examiner wants you to focus on specific matters for planning the first year audit. Or is the examiner asking for how do you correspond with the previous auditor? Is the question asking you that? Is the question asking you actions to correspond with the previous auditor? No. The question is asking you what sort of matters you will focus on when you're planning the first year audit. So why are we telling examiner how to correspond with the previous auditor? What is the process of corresponding with the previous auditor? Yes, this interaction with previous auditor must have been done when you were taking the screening of the client. I totally agree with you, Ziaur Rahman. But from that interaction, the interaction you had previously with the auditor, would that have helped you in planning the audit as well? The interaction you had at the stage of client screening, would that help you in planning the audit? Would that help you in knowing which areas to focus on? Are you getting my point, Ziaur Rahman? So you need to interact with the previous auditor when you are planning the first year audit. And through that interaction, you need to identify the areas you should focus on, the accounting policies you should focus on, the related party transactions you should focus on, because you have less knowledge of business as being a new auditor. So you need to take the help of the previous auditor. Further, the examiner is telling us they were also able to take more journal planning methods and describe them in the context of a new client. For example, additional time to understand the systems and control due to lack of knowledge from the previous audit. Do you believe when you're performing the first year audit, you need to spend more time in understanding the system, in documenting the system, in performing the test of controls, and performing the substantive procedure? Do you need extra time in the first year audit? Is that something important when you're planning the first year audit? Tell me. All of you. Is that something extremely important, that the additional time you require, you should do a planning for that? Because you need additional time, right? Because you're doing the first year audit. And obviously, you need to audit the opening balances. Is that something very important when you're planning the first year audit? Audit the opening balances. Do you need extra time for this? Need extra time and need extra efforts for this when you're planning the first year audit? So does a first year audit require more effort than a recurring audit? Does a first year audit requires more effort than a recurring audit? Does it require more documentation? Does it require more knowledge? So if you compare the first year audit with the recurring audit, what is the difference? Compare a first year audit versus a recurring audit, and probably you get the answer. Just for the sake of knowledge, you compare the first year audit with the recurring audit. Number one, requires more resources, requires more time, require more documentation, of the systems, policies, procedures, and understanding of the client. Example, the permanent audit file. You need to document a lot in the first year audit, right? Like the permanent audit file, you need to understand a lot about the client. So comparing the first year audit versus the recurring audit, what sort of planning matters are you focusing on? The first year audit requires more resources, requires more time, requires more documentation, critical review of risky areas. The risky area understanding needs a lot of careful analysis in the first year audit, because you don't know anything about the company. So you need a lot of careful analysis of the risky areas, and you need to spend a lot of time on identifying the risky areas or areas to focus on. When you are comparing the first year audit with the recurring audit, the role and support of the previous auditor in sharing information with the new auditor is extremely important, because the previous auditor will tell you where to focus on. So the role and the support of the previous auditor in sharing information with the new auditor is extremely important when you're planning the first year audit. So you need to find the fundamentals of the first year audit: resources, time, documentation. Risky areas are greater in the first year audit, including the opening balances. You need to find the role and support of the previous auditor in the first year audit. You need to find opening balances as a very specific area when you're planning the first year audit. A greater need of professional skepticism, a greater need for professional skepticism when you're performing the first year audit, a greater need of performing analytical procedures on the financial statements because you gain more understanding of the risky areas in the first year audit, a greater need of performing analytical procedures on financial statements to gain understanding of the risky area, even though you do analytical procedure even in the recurring audits, but there is a greater need of that in the first year audit because you gain more understanding of the risky areas in the financial statement. So opening balances is a very specific area in the first year audit. Professional skepticism is higher in the first year audit. Performing analytical procedures becomes more greater in the first year audit. Greater. That's extremely important. So I hope you get a relevance of comparing the first year audit and versus a recurring audit. So is planning a first year audit more critical? Is planning a first year audit more critical? Do you need more time? Do you need more efforts? Do you need more resources in planning the first year audit? Do you need to identify the risky areas more carefully in the first year audit? Do you need to investigate the opening balances when you're planning the first year audit? So are there additional specific methods in the first year audit which are different from a recurring audit? Are you clear, all of you? So please clear your mindset. Please know the difference between a first year audit and a recurring audit. What is so different with the first year audit? Why first year audit have more risk? Why first year audit have less knowledge of business? And that is where the auditor needs to do the planning. The auditor needs to do planning for areas of focus. The auditor needs to do planning for less knowledge of business. He needs to gain more knowledge. Even the previous auditor is helping you gaining more knowledge. So examiner is saying that the stronger students really identified the planning matters very, very carefully. And examiner is giving you an example of that right here, if you can read this out. So examiner reports are good. Examiner reports even give you an idea of the answer. See, have we evaluated the answer of the examiner? No. We just evaluated the report of the examiner and we found a certain answer. I hope you're clear with what to do in the 6 marks, matter specific to the planning of the first year audit. So what specific matters will you be focusing on? Specific matters like time, like documentation, like risky areas, like the support of the previous auditor, like opening balances, like a greater need of professional skepticism. I've already given you a list of 8. You need to connect that with the grubber company. I hope you're all clear, right? Yes, you need to define the materiality level in the first year audit, because higher the risk, lower the materiality. So even defining the materiality is part of planning, but that's something very general, right? What are specific matters? Materiality is not a specific matter, right? It's like a more general matter. The auditor do audit on a materiality basis. But yes, that is one of the matter which is considered at the planning stage. But are you all clear with what is to be done in the first question? So how many marks will you get for every matter? On your screen, each planning matter specifically discussed will give you 1 mark. So you have 6 marks divided by 1. So how many planning matters you need to write? 6 matters. We got some of them right. Opening balance is 1 matter. Previous auditor is another matter. Documentation is another matter. Risky areas is another matter. And the list goes on. You need to find 6 matters to write. That means your answer will be in 6 paragraphs. Every paragraph will cover 1 matter. And what should be the length of every matter? I think maximum 2 sentences. Maximum 2 sentences long will be 1 matter. So you need to write 6 paragraphs for 6 matters. And every paragraph will be like 2 sentences long. A sentence means where you put a full stop, right? I'm not saying 2 lines. I'm saying 2 sentences. There is a big difference between lines and sentences, right? So is everyone clear with what the requirement was asking for? Now, is everyone clear with the matters you should focus on in planning a first year audit? Is everyone clear? Okay, that's great. Now, just one last thing in moving to the next requirement, back to the examiner report, see what is the examiner telling here. Examiner is saying, just give me 1 minute if I can take it to my Word file, support file. Okay, now the examiner is telling us the weaker students did what with this question. And this is what the examiner is telling us. Examiner is saying this is what the weaker student did. Just give me 1 second, sorry. Okay, can you see the weaker students on your screen now? I've just taken it from the examiner report for the same question. Weaker candidates tended to either focus on acceptance, for example, requesting clearance from previous auditor. When the examiner was telling you, we have already accepted grubber. That means we have already taken clearance from the previous auditor. So, for example, requesting clearance from previous auditor, comma, which has already been obtained, or discuss generic planning methods such as assigning a team, understanding the business, and agreeing the deadlines, full stop. As the requirement asks for specific matters to be considered in developing the audit strategy for grubber, the examining team are asking for matters which are relevant to grubber rather than generic or non-specific one. Even if you're writing generic, you should link them to the case study. If a generic matter is linked to a case study, for example, deadlines, or for example, assigning a team, but that is linked to a case study, will be valuable. But if you're just journally writing, assigning a team, or if you're just journally writing, developing the audit strategy, that's useless. So please ensure that you read the examiner reports. I hope you're finding examiner reports productive. Examiner is giving you insight of a weaker student answer, and examiner is giving you an answer for a stronger candidate. Just for 6 marks, see how much the examiner is telling you. You can learn so much from the examiner report. Is that true? Is that false? Are you learning a lot from examiner reports just for 6 marks before we move to the next requirement? So are the examiner reports important? Will you develop a habit of reading them, the one which I have mentioned on the day 1, over the next 17 days you have now? Please ensure you read examiner reports for every question you are attempting. We just saw a 6 marks requirement. Back to the platform. Okay, this is the platform, right? We were looking at the briefing note, and in the briefing note, we have the first requirement, matter specific to the planning of the initial audit engagement, 6 marks. So you need to write 6 matters here. You will write 6 matters here, 6 matters, each for 1 mark, and in 6 paras, whereby each para, because it's a 1 mark answer, so each para should not be longer than 2 sentences, should not be longer than 2 sentences. So you can wrap up the answer quickly. So that's the rule of thumb. You need to write the answer for the 6 marks. I hope you can do justice writing the answer for 6 marks. I am not wasting time in this critical session in writing the answer for miscellaneous areas. I need to focus on more critical areas like evaluate the significant audit risk. Is everyone ready for the second part? Evaluate the significant risk. Okay, what is the examiner telling us? Should we identify risk from all 5 exhibits? No. Examiner is telling us you should only identify risk from the first 4 exhibits. So are we touching on the 5th exhibit for risk? Are we reading the exhibit 5 for risk? No, we are only reading 4 exhibits. Have we already read the first exhibit, which was a partner email? And what important thing we got to know from a partner email? It's a new audit client. That is the only information. But is a new audit client an audit risk? So do we got to know about it's a new audit client from the first exhibit, the partner email? Yes. So how many further exhibits we have to read now? Because we've already read the first one, which is a partner email. So how many more exhibits we have to read? 3. Number 2, number 3, number 4. Right? So, and that will wrap up the answer for 24 marks. Now, just before starting the answer for 24 marks, where I will be spending most of my time, examiner is asking us, evaluate the significant audit risk. What is the literal meaning of the word significant? Let's go back to my presentation and share some good knowledge with you from the examiner report. And I'll directly show you the examiner report because I've just copied from the examiner report a content for my presentation. I hope you can see the presentation on screen. Significant audit risk. This is exactly what I have taken from the examiner report. I'll just show you the direct paragraph from the examiner report. Significant audit risk, which I have just made a mnemonic SAR. Significant audit risk, SAR. Significant audit risk is a risk that are either specific to the scenario, So if a risk is identified from a scenario, will it be a significant audit risk? Tell me the answer. If a risk is identified from the scenario, will it be a specific audit risk? Everyone, yes. So a new audit client, is it a specific risk from a scenario? So is a new audit client a significant risk? Yes, it is, because it's specific from the scenario, comma. Next, non-routine, something which is non-routine. Non-routine, something taking place for the first time. How many times you read the question number 1 and the examiner tells you that the company is doing something for the first time? For example, purchase of a new investment property, purchase of a new investment property, purchase of a new license, non-routine, anything which is new, right? Anything which is new, anything which is done for the first time is non-routine. The depreciation of the fixed asset, is that non-routine or is that routine? Routine. Amortization of the tangible assets, amortization of the intangible assets, sorry. Routine, non-routine, routine. Something which is non-routine, something being done for the first time or something happening for the first time in the case study. Like the company is planning to acquire a subsidiary. Company is planning to dispose a subsidiary. Company is planning to expand its operation to a foreign country. Something happening for the first time, right? Non-routine. or judgmental, something which is judgmental. So many times in the question number 1, you see estimates, judgments, fair value, provisions, fair value, provisions, doubtful debts, estimates of the management, judgments. So a significant audit risk is the one which is specific to the scenario number 1. It is non-routine number 2. It is judgmental number 3, and have the potential to give rise to a material misstatement. So anything specific to a scenario which has a potential to give rise to a material misstatement or a detection risk. So it's a new audit client. A new audit client has a potential to give rise to a detection risk. So is it a SAR? Yes, it is a SAR. So something specific to the scenario number 1, something non-routine number 2, something judgmental number 3, which has a potential to give rise to a material misstatement or a specific detection risk, becomes SAR. No, it's not 3 together, right? Brendan, it's not the 3 together. Anything specific to a scenario is one significant audit risk. Something non-routine is another significant audit risk. Something judgmental is another specific significant audit risk. These are 3 different things, right? These are 3 different things. Okay, look at the finalization. SAR, significant audit risk, is equal to SNJ. SAR, significant audit risk, is equal to SNJ. S, something specific to scenario. So if something is given in the case study, will that be a significant audit risk? Yes. Something non-routine will be a significant audit risk, or something which is judgmental will be a significant audit risk. So will you remember S and J? Specific to the case, non-routine, and judgmental. So is everyone clear with SAR, and is everyone clear with S and J? I've taken this exactly from the examiner report. Exactly from the examiner report. This is what the examiner is telling us. What is a significant audit risk? Is that clear? Before I give you some examples. I'm waiting for your answers. Are you clear with SAR is equal to SNJ? Okay, so what is the examiner asking us? Evaluate the significant audit risk, right? Now, just one last thing, and we're moving towards the drilling of the answer. Okay, let's go back to my practice platform. And in the practice platform, we are evaluating the significant risk. Now, the very first information which we got from the first exhibit right in front of your screen, and the first exhibit was telling us that this is a new audit client. It is a new client. So being a new client, was that a significant audit risk? Was that specific to a scenario? And is a new client capable of converting to a detection risk? So has it met the definition of a significant risk? Yes. So exhibit number 1, close. And the very first risk we got in the list of evaluate the audit risk is Grubber is a new audit client, before I write the answer. And you move on to the next one. Yes, I'm giving you example of routine and non-routine. Don't worry about it. There's plenty to come in the next 30 minutes before you are clear between routine and non-routine. Examiner himself is giving so many examples of routine and non-routine in the examiner report. I will be sharing that with you in shortly. Okay, moving on. Business and governance. Can all of you see the second exhibit on your screen? Should we read it? Okay. The company was established 15 years ago by Martin Grubber, an engineer, who has patented a new type of machine used in oil industry. So who has patented a new type of machine in oil industry? The company was established 15 years ago, right? Martin, who is the company's chief executive. See, a lot of time, the students see the word patented and they say, oh, this is ICE 38. Patents should be recognized as intangible assets and patents should be amortized over the useful life. If patents are of infinite life, they should be reviewed for impairment. No, this will be hypothetical. If the examiner wants to draw attention to the patent, examiner will give you a very particular paragraph about patent later in the case study. But just by looking at the word patent and you convert that to a risk is wrong. A lot of time, the student just pick one word and connect that to an accounting standard. No, if the examiner wants to draw attention to the patents, examiner will give you a very particular paragraph about patents later in the case study. If that is so, then patent will become a very important risk. Otherwise, just by looking at the word patent and you connect this to ICE 38 is of no relevance. So just hold whether patent is a significant risk or not. We get to know that once we move later in the case study. Okay, so the company is managed by Martin and the brother and sisters, Craig and Iris. The company board of directors include Craig as the chief executive, Grubber as a marketing director, and Kelly as a director of operations, so on and so forth. Martin is planning to sell shares. How many shares Martin have? 60%. And Martin is the owner, is the founder. The company was established 15 years ago by Martin. So is Martin the owner? Yes. He planning to sell 60% shares and retire from the business. Craig and Iris, who are younger than Martin, will retain shares, which they have 40%. In initial discussion with the potential acquirer for Martin's share begin last month. Is there a risk of management bias because Martin is selling shares and Martin wants to fetch a good price for 60% share? Is there a potential risk that the financial statements could be manipulated for a better picture, for a better performance? Do Martin wants to sell share at a good price? Is Martin the owner? Is Martin in the capacity to override controls? Is it an owner-managed business? Is Martin in a better position to override the controls and manipulate the financial statement? Do Martin wants to fetch a good price? So do you believe Martin is planning to sell his share with negotiations already underway? Is that something specific to the scenario? Is that something where the examiner has written 3 sentences? Look at this, 3 sentences. Is the examiner drawing attention by writing 3 sentences here? So is that a specific risk? Examiner has written almost 3 lines here. Are you all with me, waiting for your answers? Do you agree this is the risk of management bias, which is a very specific risk in a given scenario? So what's the second one? Martin is planning to sell share. Number 2, Martin is planning to sell his share. Control C. You go back to the briefing note. Control V. Martin is planning to sell shares. We got the second significant audit risk, something specific to the scenario. And is the examiner drawing attention to it? How do you know examiner is drawing attention to it? Look at the amount of content. Look at the amount of content the examiner has written here. Look at the amount of content the examiner has written here. Almost 3 lines. So is the examiner drawing attention to it? Yes. So Martin is selling shares and the negotiations are underway. That means there is a risk that Martin can manipulate the financial statement for a better share price. He has a self-interest. Just hold it on, move on. The company owns a head office. Is that something routine? Company owns a head office. Is that something exceptional? Have they bought a new head office? No, they own the head office. Martin is planning to sell share. Is that something non-routine or routine? Non-routine. The company owns a head office. Routine, non-routine. What's so special? Nothing. Okay, so leave it out. The company owns a head office and leases a production facility where machines are designed and assembled under a contract with individual customer. Leases a production facility. Is this a new lease? Is this the first time they've entered into a lease? Or is this like an old lease coming from last many years? So leases a production facility. Is that more like routine? Is that an old lease? Yes. All of you agree. So is that something of a significant risk? If they entered into a new lease, is there a chance of an accounting error? If they have entered into a lease for the first time, is there a chance they can misapply IFRS 16? But is this a new lease? Have they entered into a lease for the first time? No. So are we considering this as an old lease? So anything significant here? No. Leave it out. Move on. Typically, they are manufacturing machines, right, for the customer. Typically, an order takes 14 months to complete from the initial design through to the installation. This is due to the large size of machinery produced to customer and very specific requirements of customer. Is there a risk of a revenue recognition because it takes 14 months to complete the order from the manufacturing to the installation at the customer premises? Is that a very long cycle? Does that increase the risk of performance obligation? At what time to recognize the revenue? Is that something significant? Revenue recognition? Is that something complex? Anything complex is also significant, right? Anything complex is also significant. Revenue recognition is a complex accounting standard. Anything which has complexity is also significant. Do you believe revenue recognition is a risky area? ISA 240. ISA 240 says it's an indicator of fraud. How can you say this is something routine? 14 months is very complex, right? If you record revenue too early, will that overstate the revenue? Will that overstate the profit? Is that something significant? Revenue is very voluminous, right? Revenue is very voluminous. How can you say revenue is a routine area? Revenue is a very complex area. I hope you're getting my answer, everyone. Those who were thinking that revenue is like a routine area. Are you fine with my explanation? Waiting for your answers. Are you fine with revenue? Performance obligation? So complexity is also significant, right? Any accounting standard which involves complexity, like revenue recognition. Yes, revenue is routine but complex. Very good. Revenue is routine, no doubt, but complex. Why complex? Timing of recognition, cutoff. When will you recognize revenue? So do you all agree that there is a big risk in revenue? Timing of recording revenue. So timing of recording revenue, is that a complex area? Timing of recording revenue, is that a complex area? And anything which is complex is significant? Yes. So we have another risk, revenue recognition. Revenue takes place over 14 months. So we have another risk, revenue. It takes 14 months to complete order. Next one. Order takes 14 months to complete. Control C. We take it back to my briefing note and we paste it here. Order takes 14 months to complete. So at what time will you record the revenue? At the start of the order or when it has been installed at the customer premises? I think the performance obligation gets meet up when it is installed at the premises of the customer because the risk and rewards are transferred or you have delivered the performance obligation. So order takes 14 months to complete, right? Exhibit number 2 done. Okay, let's open up the exhibit 3 now. Okay, can you all see the exhibit 3 in front of your screen now? Can you all see the exhibit 3 in front of your screen now, which has extracts from the financial statement? Now, whenever you see a financial statement extract given to you in the exam paper, and you want to evaluate the significant audit risk, and you know the definition of a significant audit risk, something specific to the case study or something non-routine or something judgmental. Now, if you're a clever student, an examiner has given you an extract of a financial statement. Can you see the note numbers? Note number 1 with revenue, note number 2 with operating profit, note number 3 with profit before tax, and note number 4 with intangible assets. So if the examiner has given you a note number, that means that note number is a specific risk. That note number is a specific risk. So how many note numbers we have? 4. So minimum, how many specific risk we have? Minimum, how many specific risk we have? 4. There is a possibility that within one note number, there are more than one risk. There is a possibility that within one note number, there are more than one risk. But minimum, how many risks we have? 4, right? So should I go back to my briefing note and say note number 1 without even reading what it is in the note number 1? Note number 1, note number 2, note number 3, and note number 4. I'll just complete the sentence once I read the note number 1, 2, 3, 4. But look at my list of risks. Grubber is a new audit client, risk number 1. Martin is planning to sell shares, risk number 2. Order takes 14 months to complete, risk number 3. Then note number 1, then note number 2, 3, and 4. So already I have 7 risk in my list in the order. Have I read the case study in order? Have I read the case study in order? That is also very important. You need to read the case study in order, and you need to find the risk in order. You need to find the risk in order. That is also very, very important. Okay, let's see what's the note number 1. We have the revenue number 75 million. Can it help us to find the materiality later? We have the profit before tax number 14 million, and we have the total assets 120 million. So if I can just note the numbers of numbers over here, so at least I can find the materialities later. Materiality, I will erase it once I complete my answer, but in the exam you can do a rough working. Materiality, we have revenue at 75 million slash we have profit before tax at 14 million. So again and again referring to exhibit 3 will be very difficult. And total assets are 120 million. So I can put these numbers on my briefing note, and once I complete my briefing note, I can simply delete them. But I think it's far better again and again jumping to exhibit 3 and looking at the numbers. It is very botheration, right? That you jump again and again looking at the numbers. So every time you need to calculate the materiality, will you come back to exhibit 3? No. Every time you have to calculate a materiality, the threshold of materiality is written on the briefing note. Can you all see this? Is it more easier writing the thresholds once on the briefing note and you can delete them later? Are you all fine with it? Okay, that's great. Okay, moving onwards. So look at the note number 1. The note number 1 tells us revenue is derived from contracts involving design, manufacture, and installation of a machinery. And how much time that takes? 14 months. Currently, the company established all of its customer contracts to contain only one performance obligation. There's only one performance obligation, right? The successful installation of the machinery at the customer premises. That's wonderful. Is that the right accounting treatment? Yes. Once the machinery gets installed, the performance obligation has been met and you record the revenue. Is that the right accounting policy? So it takes 14 months to manufacture a machine and to install it. So when is the company recording the revenue? When it gets installed. So is that the right accounting policy? Yes. But look at the twist. Look at the twist in the next line. However, around a quarter of the contracts, that's 1/4 of the contract, right? Also include a 3-year support service for machinery installed. A quarter of the contract includes a 3-year support service for the machinery installed. Is this another performance obligation? What about the revenue? What about the revenue coming from the support service? Should we record the revenue from the support service after 14 months have been completed? No. Or should we record the revenue from the support service over a 3-year period? Should we record the revenue from the support service over a 3-year period? Tell me. Or should we record it at the end of the 14th month? So do we have two performance obligations here? One performance obligation is installation of the machinery, right? And one performance obligation is 3-year support service, 1/4 of the contract. So is there a risk that the 3-year support service is recorded early? The 3 years revenue from the 3-year support service is recorded with the other revenue early. Is that the risk? Right? So I think the risk number one is around a quarter of the machine includes a 3-year service support. Control C, note number one. So this is a particular risk in the note number one, right? So order takes 14 months to complete. Is that a risk? No, because they have the right criteria to record revenue. So I'm deleting that from my list. Order take 14 months to complete. That's not a risk because the performance obligation criteria set by the company is very appropriate. Or do you all agree with me? So machine takes 14 months to complete and gets installed. And that is the time when revenue is recorded. So is that a risk? No. Delete. Now what's the risk? Around a quarter of the contract includes a 3-year support service for the machinery installed. What if the revenue is recorded early? You should defer the revenue over a 3-year period. You should defer the revenue over a 3-year period. And you should record this as an unearned revenue, as a deferred income. And each year, you should take a proportion of that to your revenue. Am I right? So is there a risk that revenue could be overstated if the revenue is recorded early? Is there a risk that revenue could be recorded early and that overstates the revenue? But that risk is with 1/4 of the contract, right? Not with all contracts. But that is a specific risk, and that is the complexity of recording revenue, making it a significant audit risk. Is it a specific risk to the case study? Yes. Being a specific risk to the case study, it is a significant risk. Moving towards the note number 2, operating profit. Operating profit includes a profit of 2.2 million. So operating profit includes a profit of 2.2 million relating to the Argyle contract. So there is an Argyle contract, and operating profit includes a profit of 2.2 million relating to the Argyle contract, details of which are given in Exhibit 4. So we have to read the Exhibit 4 for the details of the Argyle contract. A profit includes 2.2 million relating to the Argyle contract. This is a full amount of profit estimated to be made on the contract. The company's CFO suggests that while the company's accounting policy is to use the output method to determine the stage of completion of the contract at the year end, it is appropriate to recognize the full amount of profit. Can we recognize the full amount of profit on a contract? Is that right? When the company is using an output method to determine the completion stage? What is the relevance of an output method? In the output method, which is the right accounting policy, you should determine the stage of completion on the basis of the work certified. And on the basis of the stage of completion of the work certified, what is the amount of profit you can recognize? You can only recognize the amount of profit by virtue to the stage of completion. Can you recognize the full profit? No. Can you recognize the profit by virtue to the stage of completion? Yes. Can you record the profit in the operating profits? Yes. So what has the management done wrong? Have they included the profit wrongly? No. Have they determined the profit wrongly? Tell me, have they determined the profit wrongly? Do we record it? They have recorded the full profit. Should they record the full profit? Or should they record the profit by virtue of the stage of completion? Tell me. I'm waiting for your answers. Should they record the revenue by virtue, should they record the profit by virtue of the stage of completion? Yes or no? What is the output method under the IFRS 15? The output method says you need to determine the stage of completion, and on the basis of that, you recognize the profit. There is a risk of management bias, right? Higher the profit, Martin will get a good share prices. Martin will get a good share prices. Why are they recording the revenue in full? Why are they recording a revenue in full? Because that will give a good share prices to Martin. Agree? Agree with that, all of you? So Saleh is giving a good answer. Saleh is saying they should record profit according to the stage of completion. That's perfectly right. But are they recording the full profit? So is currently the operating profits overstated? Is operating profits overstated currently? Have they done it deliberately to fetch a better share prices for Martin? Quite possible. So what's the risk in note number 2? In the note number 2, there is a risk known as the Argyle contract. We'll see the exhibit number 4, right, for the details. But Argyle contract looks like a specific risk once we fetch the answer. Another risk in the note number 2. So note number 2 have 2 risks. There is another risk in the note number 2. Operating profit also include a loss of $700,000 relating to the Johnson contract. So there is a Johnson contract as well. So there was an Argyle contract and there is now a Johnson contract. Now, in the case of the Argyle contract, they have recorded the profit in full when they should have recorded the profit by stage of completion. So that shows the risk of management bias. Now, there is a contract with a loss, onerous contract, a loss-making contract. And the operating profit includes a loss of 700,000. Details of which is given in the exhibit 4. The loss is determined based on the estimated loss of 840,000 pro rata over the number of months completed. Should we recognize the loss on a pro rata basis, or should we recognize the loss in full? Should we recognize the loss in full? Yes. Is the management understating the losses to give a better share prices to Martin? They were recording the profit in full, which was wrong, and they are recording the loss partially, which is wrong. I hope you're getting the sense of the risk of management bias here, because Martin wants to sell 60% shares. So onerous contracts, do we recognize the loss in full on the onerous contracts? All of you, give me an answer quickly. Yes, exactly, Brendan. They are massaging the figures. So is Johnson contract a specific risk? So note number 2, Argyle contract and Johnson contract. Is everyone clear? Let's look at the note number 3. Profit before tax includes an estimated increase in the fair value of the Nakatomi building, investment property of 2 million. Details are provided about this investment in Exhibit 4. Fair value adjustments of the investment property, are they taken in the profit for the year? Yes. They are not taken in other comprehensive income or comprehensive income. They are taken in the profit for the year, which is perfectly right. But is the fair value estimated? Is it judgmental? Is it a significant audit risk? I think the only thing wrong here is the estimated fair value, which is a risky area. There is a possibility that the fair value has been adjusted upward for giving better share prices to Martin. So should we recognize the increase in fair value in the profit? Is that the right accounting treatment for investment properties? Yes. Can we record investment properties at fair value? Yes. Do the ISA give us the permission of that? Yes. But what is wrong? The estimated increase in fair value. So what if the fair value is wrong? Can the profit be overstated if the fair value is wrong? So we have a Nakatomi building. in the note number 3, where we have a very specific risk, Nakatomi building, and the fair value of the Nakatomi building becomes a very specific risk. And you move to the last one. Note number 4, the change in the value of intangible assets represents a transaction which took place in March 20x5. So change in the intangible asset. How much is the change in the intangible assets? From 10, they've become 19. So 10, they become 19. So the change in intangible asset represents a transaction which took place in March 20x5, whereby Grubber Company purchased some designs from Martin Grubber for $9 million. Is this a related party transaction? Grubber Company purchased designs from Martin Grubber for $9 million. Is this a related party transaction? Tell me. Grubber Company purchased some designs from Martin Grubber for $9 million. Is this a related party transaction? Should we have proper disclosures of this? Are you all with me? Okay. The value of this transaction was determined by Martin. Would Martin likes to determine a higher value of this transaction so that he can overstate their total assets to fetch a better price? So Grubber Company purchased designs from Martin Grubber for $9 million, and the value of this transaction was determined by Martin Grubber. Is that risky? Is there a risk that Martin Grubber would determine a higher price for fetching a better share prices? The audit partner has asked for information to support the value, but nothing yet received from Martin. So is Martin trying to conceal information from the auditor? Does that make $9 million risky? Does that make $9 million with a potential risk of overstatement? So is Grubber giving us information about $9 million? No. So does that increase the risk that this $9 million could be overstated because Martin wants to fetch a better price? So is this a specific risk? Yes. So have we completed the exhibit number 3? Yes, we have completed the exhibit number 3. Now in the exhibit 4, the last one, before I have the electricity failure in the next 4 minutes, I just need to wrap up the day 2 part 1 and then resume back at 5:30. The last exhibit, business development. Now in the last exhibit, business development, we are getting information about the Argyle contract, which is a contract on which you have to recognize the profit. Then there is a Johnson contract, which is a loss-making contract. And then there is the investment property. Now we've already read about them, but something which is important. We need to determine the stage of completion for Argyle contract, right? Because we need to recognize the profit on the stage of completion. Let's see what is the stage of completion. The agreed price of the Argyle contract is $6 million. And Grubber Company will have incurred cost of $2.6 million by 30th of September. So how much cost have been incurred? 2.6. What is the agreed price? 6. So what is the stage of completion? What is the stage of completion? 2.6 divided by 6 million. So you need to find the stage of completion, right? Which we will be doing in the second part of the day 2. You need to find the stage of completion, and then you need to find how much is the proportion of the profit recognized. So the stage of completion is 66.7%, right? So how much profit should be recognized? 66.7%. How much is the profit? $2.2 million. So how much of the $2.2 million should be recognized? 2.2 million multiplied by 66.7%. So how much of the profit should be recognized? That's the exact amount. The else is the overstatement. So out of the 2.2 million, how much should be recognized? You need to find the answer for that, right? For the second part of the session. Johnson contract, how much of the loss should be recognized on the Johnson contract? The entire 840, right? So the entire 840 should be recognized as a loss. Currently, how much loss have we recognized? 7. So how much loss is to be recorded more? We should record another $140,000 loss, right? So currently we have recorded less losses, right? We have recorded less losses. Investment property. Okay, how much is the fair value of investment property? 2 million. The company is going to appoint an expert to provide a valuation. Have the expert already done a valuation? No. The company is going to appoint. So have they already appointed an expert? No. So who has determined the $2 billion? The initial estimate of fair value of $2 billion has been included in the company's financial statement. So who determined the initial estimate? Martin, because the expert is yet to be appointed. So does that make this $2 million risky? Does that make this $2 million subjective? Does that make this $2 million with a risk of overstatement? Right? So we have three specific informations coming in the Exhibit 4: investment property, the Nakatomi building, the Johnson contract, the loss-making contract, and the Ergal contract, on which I will be wrapping up my answer in the next part of the day 2. No, in the case of the Ergal contract, because we're using the output method, so we are taking the percentage of completion by virtue of work certified, right? Output method says work certified. So we have to use the work certified as a stage of completion. And in the case of Johnson contract, the 12 months is useless, because if it is a loss-making contract, we should record the loss in full. We should record the loss in full immediately. I hope you're getting my answer. Okay, so that wraps up the exhibit number 4. Back to my briefing note. Can you see the number of risks we have identified on briefing note now? Evaluate the significant risk. If I can just copy this from here and take it on my Word file for a proper answer plan, Control C, and I take it on my support file where we are working post break in the second part, the answer with the examiner comments, interesting examiner comments. Just give me 1 minute, sorry. Okay, so we are now attempting September, December 21. Question number 1B, evaluate the significant audit risk. Evaluate significant audit risk. And this is what we got from it. See, I just copy pasted my answer here. And how many risks have we got? We got almost like 7 risks from the case study, right? Which needs to be converted to proper answer. I must have missed some of them out while I was reading, but this is, I hope this exercise must have given you some way of reading through. I read in a systematic manner from Exhibit 1 to Exhibit 2 to Exhibit 3 to Exhibit 4. I tried finding the risk in order, like Grubber is a new audit client, Martin is planning to sell shares. Note number 1, quarter of the contracts also include a 3-year support service for machinery installed. The Ergal contract, the Johnson contract, the Nakatomi building, and Grubber company purchased some designs from Martin company for $9 million. Now I'll show you the way to write answer. I'll show you the examiner criticism along with the points on your screen. I will not be writing all the 7 points, but I will be writing at least 4 of them, so you get a good relevance of writing. I will show you the examiner criticism and particularly some examples of a routine transaction versus a non-routine transaction once I go into the examiner report. But I hope you're all technically clear with the word significant risk. Are you all clear with significant risk? Are you all clear with a significant risk means something which is from the case study, something which is non-routine, and something which is judgmental? Even a complex accounting treatment is a significant risk. So have you enjoyed the process of identifying risk? Have you enjoyed the way we have identified risk and put them down on the briefing note? Okay, now the next step is to convert them into answers, right? Which will take place in the second part of the day 2 today, where I will be wrapping up the answer for B. Then we need to find the answer for C, which is the audit procedures, which will be a very interesting exercise in the second part today, where I will be looking at the procedures for 8 marks. And the ethical issues, I'll be ignoring ethical issues because I believe students are good in picking up the ethical issues, which is the D part. But I will keep a strong focus on answering audit risk in the second part of day 2 and procedures, because procedures are extremely important. And I will be sharing the examiner insights with you and the marking scheme for audit risk. How many marks you get per audit risk? What are marks for materiality? If you find a calculation, do you get extra marks for that? If you find a percentage increase or decrease, do you get an extra marks for that? So these are all the questions to be addressed when I meet you back for the second part of this webinar to success for June 22 exams. So currently we're going off, and I'll resume back with the day 2 part 2 at 5:30 for the next 90 minutes, and we'll wrap up the day 2 agenda. How was the day 2 today? How effectively you found day 2? Have you got something from the day 2? Have you found some productive learnings, insights from day 2? So you need to be very good on accounting treatments like the output method, like onerous contracts. So that is exactly what I was telling you on the day 1. You should revise the accounting standards even from the examiner answers. So if you read the examiner answer, you will get to know about the accounting treatment for onerous contract. You will get to know the accounting treatment for the output method. You will get to know the accounting treatment for related party transactions. You will get to know the accounting treatment for performance obligation. You can learn a lot of accounting treatment from the examiner answers, right? Because within one question, there can be multiple accounting treatments. So I hope to see you all back in the second part. So till then, take good care of yourself, study effectively, and I'll see you back shortly with the part 2 for day 2, working on the other parts of the question number 1, audit risk and audit procedures with the examiner report and the marking scheme. I'll see you back shortly. Goodbye and Allah Hafiz.